All right, so we are seeing more volatility unfold in the bond markets. This is the 10-year treasury yield. It's coming in at 5.49%. It took a major leg down here on the news that inflation numbers were better than expected, followed by a small rebound. Now, this, of course, is really good for mortgage rates, but this volatility is still creating uncertainty in the housing market, and it is sidelining many would-be buyers and sellers. Banks are feeling it too. The spread between the 10-year and the 30-year fixed rate mortgage remains historically elevated with a gap of about 300 basis points, where normally we would see anywhere from 150 to 200. Now, this gap is signaling that the markets are unsure where we are headed into the future, whether or not the Fed will pause on their rate hikes or if we will see more rate hikes at the upcoming meetings. Now, this puts the average 30-year fixed mortgage today at 7.45%, which is, of course, about 0.5% below the peak that we saw just a few short weeks ago at 8%. Now, this is an improvement, but it still ultimately hurts because the average home buyer today needs to earn around $115,000 per year to afford the median priced home, which is right at about $400,000. And if you're curious as to whether or not the rates will bring home buyer demand back in, let's go ahead and take a look at the math. If we look at the median priced home at about $400,000 with a 20% down payment where rates were at just over 8%, the mortgage payment would have been $2,913. Whereas if we do the same exact inputs, but we take today's mortgage rate sitting at 7.45%, we would see a monthly mortgage payment of $2,784 per month. Now, this is a $129 difference per month. So I will let you decide on this one. Is $129 enough to move the needle? Let me know in the comments below. All right, there is no doubt that there are affordability challenges in the housing market, but if we shift gears a little bit, let's take a look at where inflation is and where it isn't. Now, to be clear, consumer price index rose to 3.2% over the last 12 months. That's ending in October. And it is, on a positive note, it's clocking in at the lowest annual rate since March of 2021. Now, if you look at this chart, you can actually see where the primary drivers of inflation are and what is keeping inflation so sticky. Well, right now, it's items like rent coming in at 7.2%, personal care at 6%, restaurant at 5.4%, housing at 5.2%. We're seeing recreation at 3.2%, prescription drugs 3.1%, education 2.7%, groceries still coming in at 2.1%. And one of the key distinctions that I want to make sure everyone understands is that when you see inflation with these positive numbers, it means that the cost of goods and services are still going up. They are becoming more expensive. Even though inflation is coming down, we're coming off a peak of 9%, this still means that the cost of goods and services are going up. In order to see prices actually come down, we would need to see these negative numbers. And a good example of that is the price of oil has gone down recently, which is driving gasoline prices down on a national level. And currently those prices are down about 5.3%. All right, so inflation and affordability are certainly making some waves here in the housing market. In fact, one of the biggest headlines is that Zillow is now walking back their bullish forecast on home prices. They actually downgraded their home price forecast, predicting that prices would now fall about 0.1% between October 2023 and October of 2024. So over the next 12 months, Zillow is forecasting that prices will actually decline slightly. In my view, they're basically saying that they're going to stay flat. This map right here actually shows its regional home price forecast for the nation's 400 largest markets. And you can see that areas in the red here, they actually anticipate negative year-over-year price growth. So like areas in the West, certain spots in Texas and in the Midwest, they're forecasting now that prices will actually decline, whereas in the blue is where they anticipate home price appreciation. What's interesting is this downgrade actually marks the third straight month where Zillow revised its forecast down. In fact, if we take a look at this chart, which was released in August of 2023, Zillow was predicting that we would see home price appreciation of 6.5% on an annual basis. You can see everything lit up in blue here, anticipating nearly every market that they track was going to see price growth. Well, that was revised down to 4.9% and then 2.2%. And now, released here in November, we are seeing the negative 0.1% year-over-year growth. This, of course, is most likely due to mortgage rates remaining elevated and staying north of 7%. And if we're taking a look at different forecasts forecast for mortgage rates, which of course you have to take with a grain of salt because even the big players, the experts, they don't get this right all the time. In fact, in late 2021, Mortgage Bankers Association was forecasting that mortgage rates would rise to 4% by the fourth quarter of 2022. And of course, we all know that mortgage rates went substantially higher than that. So if we look at Q1 of 2024, Fannie Mae is predicting rates at just over 7%, MBA is at 6.8%, and Goldman is at 7.3%. Now, by the end of the year, Fannie Mae is predicting rates at 6.7%, MBA is at 6.1%, and Goldman is at 6.8%. They are all predicting that mortgage rates will come down, but the overall theme is that rates will remain higher for longer. Now, the silver lining in all of this is that buyers are finally starting to get a little bit more leverage, and sellers, they are coming to realize that they no longer hold all the cards. They're needing to make concessions just to put these deals together. Buyers are successfully negotiating concessions, which is like your rate buy downs and your closing cost credits, in 35% of transactions. So that's just over a third of all transactions that are taking place have concessions attached to them. And I suspect that as we look back on this data here in a few months, we're likely to see this number increase because, of course, seasonally going into the winter time, it becomes a slower time for real estate. Of course, this is not the same in every market. You want to see something crazy? Take a look at this chart here. This is the share of home sales with concessions. I pulled the top 10 or 15 markets here. Look at Salt Lake City, 63.3% of home sales have concessions. In fact, if you take a look at everything over 50%, you have Portland, Charlotte, Phoenix, Raleigh, Las Vegas, Denver, and San Diego. These are all north of 50%, which means 1 in every 2 homes has concessions tied to their home sales. And a few other markets which are close to 1 in 2, we see Los Angeles, Atlanta, Dallas, Houston, and Sacramento. Some sellers are needing price cuts here as well. So we already know 35% of sellers are agreeing to concessions, but 14.4% are taking concessions and they're still selling below their list price. 11.5% are negotiating concessions and they're dropping their price. And then 6.4% of sellers are providing concessions, they're doing price drops, and they're still selling below the list price. The real estate market does tend to move very slowly, but it finally feels like the pendulum is swinging back towards the buyer, giving them more negotiation power in today's market. That will wrap it up for today's video. If you got any value out of this, please consider hitting that like button and subscribing. It really helps grow and promote the channel, and I certainly appreciate it. Have a wonderful day. Take care.